But perhaps the biggest determinant of those who create wealth and those always stuck chasing their next paycheck is the ability to refrain from spending everything you earn. Whether you earn a little or a lot, you'll never be wealthy if your lifestyle matches your paycheck. The sad truth about this is 94% of wealthy people save 20% or more of their income, while only 5% of poor people do the same.
The sad reality is that the average American is spending $18,000 a year on non-essential items and $300 a month on random impulsive purchases.
If it's not an emergency, you don't use the emergency fund. Well, Dave, we're getting a couch. That's not an emergency. We need a bass boat. That's not an emergency. Christmas is not an emergency. It's always in December. They don't move it. So these are not emergencies. An emergency is an unexpected event. The more planning you do, the more budgeting do you do, the more margin there gets to be in your money, the less likely you are for something to be declared an emergency.
Yep.
The more likely you are to cash flow it out of the budget.
Our emotions and our money are 100% connected. A lot of people's spending comes from an emotional void. This emotionally makes me feel good. I don't feel good unless I go shopping, and this helps me feel better, or I'm depressed. Even in couples, that now translates into love language. Oh, when you buy me gifts, I feel more loved. Or when we're spending money together, or we can go out to eat whenever we want. We're not having money struggles. Our relationship is awesome. You know, there's so many ways our money and our emotions connect and then translate.
40% of all Americans run out of money in retirement. 53% of African American households run out of money in retirement. If that system is broken, everything breaks down. So if your parents, can't run out of money in retirement, then you have to start funding them because they don't have money. So that's taking money out of what should be your nest egg, which you should be passing on to your kids. So it's just a generational deficit if we can't retire the right way.
Imagine the person that's 60 years old and they've been in their career for a bit of time, and at the height of their career they're making $80,000 a year. They made 80 grand a year and that was their lifestyle, and you have $180,000 saved up for retirement. Let's just say you got 200, like the 65 to 74s. How many years of retirement did you just save? Guys, I don't know if that scares you, but that's something that's pretty scary.
We're going to take care of our parents 2 times longer than they took care of us. If you are right now 30 or 50, under 50 years old, you could probably get a long-term care policy at probably maybe $50 a month. Because by the time you're 60, 70 years old, God forbid you have dementia and all these other things that are growing and you have to get long-term care. It costs an average of $20,000 a month to get a decent amount of long-term care. So imagine if you had $3 million in the bank and both your parents have to go to long-term care for 3 years. Your money's gone.
I don't own a home. I don't have any kids yet. Why do I need life insurance?
Yeah.
But do you have student loan debt that your parent co-signed with you?
Oh,
if you have a private, if you have a private student loan, there's a good chance that will not be discharged if anything happens to you. So that parent will be stuck with it.
Okay.
Did you take out a small business loan? If someone co-signed with you on that, or even if they didn't, that loan still has to be repaid even if it takes your entire estate. Do you financially support one of your parents or another relative? Again, it doesn't have to be your child. If there's anyone that depends on you financially, you need to consider having life insurance.
I'm going to put a trigger warning on this video. This clip I'm about to show you is my mom. A few days before she died. She had stage 4 colon cancer. She worked for Office Depot for close to 20 years. She was on short-term disability. Her last day worked was December 15th of 2022. Unfortunately, because my mom's cancer decided to kill her at the beginning of 2023. In January, her insurance now, the new insurance company won't pay because she didn't work one day, one whole day. She didn't work when the company got changed over.
Life insurance only deals with 2 things, your age and your health. So the younger you are and the healthier you are, the less you'll pay over time. The older you get and the more unhealthy you are, the more you'll pay over time. This idea that you should wait until you get older, have dependents, need it, is the wrong way to think about it. Because technically, the insurance company will probably get more money from you if you waited longer to get life insurance.
And good evening, everybody. Welcome back. Welcome back to another night of our boot camp. I hope everybody's doing well. I appreciate y'all joining again for night number 2. Last night, we had an amazing conversation. Those of you that got a chance to stick around for our conversation yesterday, we got a chance to dive into some cash flow things. We got a chance to dive into some bankruptcy, some debt things. We had we gave you the information that you needed in order to really make sure your financial life is in order. And tonight, no different. We're coming in with even more information that's going to impact you and empower you to get to wherever you want to go financially. Again, y'all, I'm your host. I'm Chris Muzan. We've been here, my wife and I have been here in the financial space going on 12 years. We've gotten a chance to sit down with people all across the country from 18 to 80 years old and lift up the hood under their financial life and get a chance to see exactly what's happening. And the number one thing we always see is that everybody's dealing with the same stuff. It's all the same stuff to varying degrees, but it's all the same stuff. We have some cash flow things. We have some savings issues. We want to get to retirement. We want to make sure our kids have college savings funds. We want to make sure that we have enough to go live the life that we want and become some form of financially independent and time free and all these things. And everyone's kind of in the same boat. So that's why we just want to come give you the information that you're going to need in order to make sure that your financial life gets to wherever you want it. We're not here to convince you to save money. We're not here to convince you to get out of debt. But if you already want to do those things and or you know people that want to do those things, then this is going to be the boot camp for you. This is the call for you. As always, like I said yesterday, whether you're watching here on Facebook or whether you're here in the Zoom with us, share this with a friend, share this with a family member. I know most people have the attention span of a peanut these days, right? So getting somebody to stick around for 3 days, 2 hours each day can be a little bit challenging. But again, people need to hear the information. And as we go through this stuff, I know you're going to think of people that should hear it. If so, forward this over to them, share this with them on Facebook, whatever you got to do to get them on, because our mission is to really make sure we're helping families build this solid financial foundation, ladies and gentlemen. You got a chance to see some of those clips there. Again, there's tons of information out here. There's tons of information out here around finances. There's tons of people having these financial conversations. Let me share this again with you. There's tons of people having these financial conversations all over, but is it right for you? That's the question, right? Is it right for you? Is it the thing that you should be doing? Is it proper for your financial situation? That's what matters. There's no blanket financial advice. There's no one financial product or one financial strategy that's good for everyone. So it really comes down to where you sit financially. But that's what we're here to help you do. We're here to help you figure out exactly where you sit and make sure we're giving you a strategy for how to do it. Again, as always, we're doing this for 3 days. So those of you that got a chance to check in with us yesterday, again, I know you got a ton from cash flow and debt management. We had Adrienne Hines on, who talked a little bit. She's a bankruptcy attorney, had some conversations around the bankruptcy space. Coming up tomorrow, we have Atia Brown getting on. She's a CPA. Tomorrow is the final day of our boot camp. And we're going to be talking about taxes and estate planning stuff. But tonight we're diving into the meat and potatoes. This is the stuff people like to talk about typically, but a lot of times, right, we're just figuring it out on our own. We're going to have this conversation around saving and investing. And then we're going to talk a little bit on the back end about insurance and protection and how to really protect your income and what all those things are for. So again, continue to stick around with us because we got a ton going on. I'm going to continue to talk fast if you haven't noticed, right? We're going to blow through this information. One, because there's a lot to cover. Two, I don't want you falling asleep on me. I know some of y'all, it's nighttime. You got home from work. You're sitting on the couch. I don't know what you're doing. You might be in the kitchen cooking. Who knows? You could be driving home. I don't want you falling asleep. So we're going to talk fast. We're going to make things happen over here. Again, feel free to follow my wife and I in our business, United Agency, anywhere on social media, whether it's Instagram or Facebook. We're over on LinkedIn. We also have a YouTube channel and a website. So you can feel free to get people plugged in, get people connected to us. The person that probably invited you, if we didn't personally invite you, The person that invited you is likely a part of our organization. They're an integral part. We're continuing to grow our team, continuing to grow the organization for people that want to be on the same crusade as us, which is helping families, building people, and a better life. That is the mission. Helping families understand finances better, get their financial life in order, building people so you become the best version of yourself. Remember, your money only grows to the degree that you do as a person. Your money only grows to the degree that you do as a person. So if you keep growing yourself, your identity, guess what? Your money will continue to catch up. And that's what we're believers in. And then also that there's a better life, that your financial life, your entire life, your health life, your spiritual life, your family life, your relational life, all can be drastically better in 6 months. All can be drastically better in 12 months. The amount of people that are missing hope, they just don't have the hope that things will get better, is startling in this country. And what we want to do is we want to impact people in those areas. So if you want to be on that crusade with us, by all means, connect with the person that invited you and or shoot me and my wife a message, because that's what we're here to do. A little recap, our job is to come put this financial foundation in place for you. The financial foundation is what allows you to build to wherever you want to go financially. I don't know all of your personal goals and dreams financially, but if you follow these simple steps, if you follow these 6 things and put these in place and then build your knowledge from there, you'll be able to get to wherever you want to go financially. So yesterday we got a chance to talk about cash flow and debt management. Those were the 2 things that we already kind of crossed off the list. If you didn't get a chance to jump on yesterday, it's still up on our Facebook, on our United Agency Facebook page. That's where it's living. We don't know if we're going to put it out or put it on YouTube or somewhere else, not sure, but that's where it is for now. So you might want to go back and take a look at it if you had questions on cash flow or debt management. Tonight, however, like I said, we're getting into the meat. We're doing all the stuff. We're doing short-term savings. We're doing building wealth, which is the long-term savings, investing, retirement side of things. And then we're diving into proper protection. All of these are the areas that we will be diving into tonight. And so again, just like I mentioned to you last night, I want you to be successful here. I know it's been a long time since some of us have gone to school. I know it's been a long time since some of us have really, stepped out of our environment and had to take some notes and had to sit down and pay attention and not be distracted, all those things. But I'm going to encourage you all tonight, whether you're here in the Zoom or whether you're watching on Facebook, use this time to be intentional about your financial life. If you are looking for something, if you have a question about something, if there's something that's been on your mind, likely if you're intentional about it, you'll get the answer, or at least you'll find the time to ask the question. But in order to do that, you got to do some things. One, you got to take some notes. I know it's been a long time. We're very used to just snapping a picture and then coming back to it in 8 months, meaning never, right? You never come back and look at your pictures of the notes that you were supposed to write down. But something special happens, ladies and gentlemen, when you connect pen with paper, whether it's an iPad, whether it's a tablet, whether it's pen to paper, something happens with how we learn. So I encourage you all, take some notes tonight. I'm going to go through a lot of information. Some of it's going to be stuff you know. I promise you, you're going to learn some things, though. It's some things you maybe didn't know. The only way you remember it, though, is if you take notes. They often say you're only going to catch or keep about 7% of what I tell you. After that, you're going to go back to your life and you're going to forget a lot of this stuff. So in order to allow that not to happen, take some notes, eliminate your distractions. If people are yelling around you, tell them to quiet down, right? Engage with us in the chat. If we say, hey, there's a question, engage with us in the chat, ask all the questions that you have. That's how you're going to be successful tonight. Capiche? All right, let's do it, ladies and gentlemen. Day number 2 of our boot camp, we're talking saving and investing. That's what we're talking about, saving and investing. So we're going to go over some strategies, short, mid, and long-term strategies. If you've worked with us before, you've possibly heard this, but it's a good refresher. If you haven't worked with us before, then this is going to be awesome information for you to structure your financial life, because most people have this stuff out of order. Why? Because where do we get our financial information? We get it from our parents, we get it from our coworkers, or we get it right from the internet. trial and error, right? So maybe we don't have the proper strategy on these things. So as a financial professional, someone that's been doing this for over a decade, this is the strategy that we have given people that will help you really sift through and pay attention to what's happening in your financial life, okay? So again, let's dive in. First with a little education. Some of you may have heard of this. It's called the Rule of 72. It doesn't say it up there, but it says the rule of, but 72 is what should be up there, the Rule of 72. The Rule of 72 says, ladies and gentlemen, that if you take the interest rate, the interest that you make, and you divide that number into the number 72, it'll tell you how long it will take for that money to double. Okay, take the interest rate, divide it into the number 72. It tells you how long it'll take for that money to double. Here's an example. If you got 1%, let's say you went to the bank and you got a savings account or a CD or something, and they gave you 1% interest. Well, 1 divided into 72 gives you 72. So that means every 72 years, your money would double. This is an example. If you were 29 years old and you put $10,000 away, it would take you to age 101 before that 10,000 turned to 20,000. Who's signing up for that one? You're like, yeah, sign me up for that 1%. Yet, do we know what we get in a savings account, an average savings account, right? Your Bank of America, Wells Fargo, Chase, right? Santander, Truist, wherever you bank, you know what your average savings account is going to get you? Less than 1%, 0.05%, 0.04%, less than 0.5% if you just put your money into a basic savings account. So that's why the bank is not there to help you grow money, but we'll touch on that as we keep going down this path. Hey, let's say we got 4% though. If you got 4% in interest, you put it in a place, you get 4%. Well, 4 divided into 72 gives you 18. So that means every 18 years, your money would double. If you didn't add anything extra to it, your money would double every 18 years. So if you're 29, you put $10,000 away, boom, 18 years later, you're at 40, you're age 47, you got 20,000. Then it doubles again 18 years later, it puts you at $40,000. Let's say you get 6%. You guys see what's happening here. 6%, by the way, is the average of what the stock market will give you back long term. So let's just say you get 6%. Well, 6 divided into 72 is 12. So every 12 years, your money would double. Same example. You put 29, you're age 29, you put $10,000 away. By age 65, you're at $80,000. Class participation. What if you got 12%? Okay, what if you got 12%? That means every 6 years, your money would double. If this were the same example and you're 29 years old and you put $10,000 into that account or whatever it is that gets you 12%, how much would you have at age 65? Go ahead and drop it in the chat. Facebook, go ahead and drop it in the chat. Zoom, if you're here, go ahead and drop your guess in the chat. You're 29, you put $10,000 away, you're getting 12% interest. So every 6 years, your money doubles. How much will you have at age 65? Let's guess. Drop some of those guesses in the chat. I want to see them. I know you didn't sign up to do math tonight. I get it. Right? It's okay. There's actually going to be some more numbers later on tonight. This might turn into a math class a little bit. But either way, just guess. Just guess. I want to see some guesses in the chat. What do you think it is? If you're getting 12% interest and you start at age 29, we got 1.2 million in the chat. Okay, good guess. 1.2 is in the chat. What else? Who else has a guess? You're 29 years old. You put $10,000 away. At age 65, how much do you have left? Come on, y'all. I know some of you aren't the brightest at math, but you could probably figure this out. I'll give you another 15 seconds to figure it out. We only got one guess in the chat. 12% every 6 years. All right, I guess y'all give up. $640,000. 640. Lisa said she failed math. I know, a lot of us did.
But this is math you got to know. Why? Because compound interest is what builds your wealth. Compound interest is what allows you to stay out of debt. That's why we got to know this stuff. But look at that, y'all. At 12%, when your money doubles every 6 years, the same example, if you were 65, you'd have $640,000. Look at that. From 6% to 12%, that's just a difference of 6%. But at the age 65, that's a difference of $560,000 in the same time period. You didn't add anything extra. You didn't wait more time. You just got a higher interest rate so that your money doubled faster. This is why interest is important. Learning how interest compounds is important, because when it works in your favor, guess what? You win. That's why people want to invest. They want to invest because they know, people start to know things like this. You start to say, oh, if I just put away $5,000 a year for my kid, by the time they're 60, they have X amount, right? It's because it's compound interest. That's why this works. Here's why you need to know this on the other side, because of what we talked about yesterday. The average credit card is about 23% interest. So let's just round up and say it's 24%. The reason why most people don't get out of debt with their credit cards is because every 3 years, the money is doubling for the credit card company. So when you're just paying a little bit over the minimum, it never gets there because the interest is racking up so quickly that you don't even have a chance. It's important to understand these lessons, ladies and gentlemen. This is the foundation of you going off and learning how to invest, because you're now constantly going to pay attention to the interest rate, because that's what matters. It's the interest. It's the interest. All right? Cool. Let's keep it rolling. Hey, did you know that the median emergency fund savings in this country is $600? I guess there is going to be a bunch of math tonight. I got to, give you some math terms. The median is the middle. The middle. So that means half of the people have more, half of the people have less. So the median emergency fund savings in this country is $600. 21% of people have no savings at all. 2 out of every 10 people don't have a dime saved. And 60% of people can't afford a $1,000 expense without going into debt. Would you say that we're in a little bit of trouble here? Would you say that we're in need of a little financial education? I would say yes. I would say yes. So that's what we're here to do. Let's talk about this strategy of saving and investing. The first thing you got to know is how to save money. I mentioned this to you yesterday on the cash flow side, so I'm going to mention it again. 3 things to learn to do with money. You have to learn how to earn it first. Then once you earn it, you got to learn how to save it, how to keep it. Then once you learn how to keep it, then you can learn how to invest it. That is the order of operations. First step is learning how to earn it. If you've never learned how to earn money, then that's where you start. We don't use the stock market or other investment vehicles to make us more money. It's to grow the money we already have earned. That's all. It's to grow the money we've already earned. But you're not going there to have that make you money. It's the easiest way to lose money. So we got to start with learning how to earn it, which is what we talked about yesterday. Now you got to learn how to save it. So here's where you're saving it. You got to start with your short term. Short-term savings is a 3 to 6 month, preferably 6 to 12 months worth of your income. I know somebody out there is like, Chris, that's a lot of money. 6 to 12 months of my income, man, I make $5,000 a month. You mean I need $30,000 set aside in short-term savings? That's a proper emergency fund. I'm just telling you what's proper. I'm telling you what will get you there to where you want to go, right? 3 to 6 months is standard. Preferably in the times that we're living in, you need 6 to 12 months of your income liquid, set aside, labeled emergency that you don't touch. Don't worry about getting a lot of interest. Don't risk it in the market. That's not what this is for. This is your security. People always want to be financially secure. Well, that comes by you having savings in the bank. If you had 12 months worth of your income set aside in the bank, you would act differently about life. I just know this, right? Like if you didn't like your job and you had 12 months saved, you would take a couple extra days off because you'd be like, I really don't want to show up today. I got a year's worth of my savings set aside. I'm not touching. I don't even need it. You would think differently. You would move differently in life. A person with savings has more confidence, not a person with a ton of investments, a person that just has savings. You just got 12 months of your income set aside. You're going to walk around with more confidence. You're going to feel good about some things. So where do we put this money? You can throw it in a bank savings. You can throw it in an online savings account. Some people just want to put it in the safe or under the mattress. Listen, I don't care. You just got to get to six months worth of your income. I prefer a high yield savings account for you. If you get a high yield savings account through one of those online banks or somebody that you might know that has an online or a high yield savings account, you can get 3.5, 4.5, maybe even 5% interest in 2025 on a high yield savings account. No risk, just set it aside. Learn how to do that. Or some people prefer CDs. I'm not a fan because it locks up the money, but it's definitely a way to save. If you can get to 6 to 12 months of your income set aside, that is the goal. That's the goal, okay? So that's short-term savings. Pretty self-explanatory, but are we doing it? Are we paying ourselves first? Are we not biting off more than we can chew? That's what we do when we work with you one-on-one. We give you how to do these things. This is the what to do, right? We show you how to do that personally for yourself. And normally it's by just making sure you're paying yourself first, okay? Here's the second part of this. This is where we get into some of the things that people love to talk about. It's the midterm investments. Your midterm investments. These are typically 2 to 10 year investments. That means you're evaluating them every 2 to 10 years. It doesn't mean you're going to keep it forever. That means maybe in 4 years, it's the time to sell this thing. In 6 years, it's time to get out. In 11 years, in 10 years, it's time to move to a different asset class. That's what this means. So these are usually in the stock market. They're your higher risk, higher reward types of investments. It could be your fund, right? Like if you've already done some things and this is where you just want to have some fun, sure. It goes towards bigger purchases, larger investments. And here's the key. Take this note because I told you to take notes. Your midterm investment goes to how you build wealth. Like this is how you build wealth. It's through midterm investments. But the only way to build wealth is if you have a specialized knowledge. Hear me again. The only way you build wealth is if you have a specialized knowledge, meaning you know something more than the average person. You've studied something more than the average person. If you have the same information as other people, you'll get the same results as them. People that build wealth have more information and knowledge that they apply about a specific asset class, about a specific subject that allows them to build wealth with that thing in a 2 to 10 year window. This is the stuff most people want to jump into right away, but it takes time to build a specialized knowledge. But this is all the stuff you talk about or you hear about. Stocks, bonds, mutual funds, right? Brokerage accounts, options trading, dividend stocks, ETFs, index funds, REITs, cryptocurrencies. And here's the big one, other asset class investing. See, these aren't things that you keep for 30 years. These are things you're evaluating that you might be in and out of in 4 years. That's how you do it. It's a flip. It's like, hey, this real estate is at its height right now. Let me sell it and buy this business with it. Then over the next 7 years, I build up the business, sell that, and buy more real estate. You see, this takes money. This takes knowledge. This takes you being intentional about it. This other asset class investing is how we build wealth. Let's show you what asset classes are. Because you got to know this. If part of your goal is to build wealth, if part of your goal is to build generational wealth or whatever that is for you and your family, then these are things you have to know. Whenever you hear a wealthy person say, hey, I've diversified my assets, I'm diversifying my assets, it doesn't mean that they picked more bonds than stocks inside of their 401k. That's not what they mean. This means they moved money across the asset classes that generate them some form of midterm investment. These are the only 5 asset classes that are out there. You have cash, which we all know, right? It's liquidity to buy anything. Sometimes just keeping cash on the side is important, especially in down markets, because then when things are on sale, you can buy a lot of them. That's cash. That's an asset class. Equities is ownership of a business.
Equities is ownership of a business. This could be the stock market, because that's technically ownership, small pieces of a business, but it could also be your own business. It could be startup funding. It could be investing in another entrepreneur. There's a ton of different things that are equities, but it's ownership of business. Then you have fixed income. Fixed income is your ability to lend money. If you got a bond, the difference between a stock and a bond, right? A stock is you buying a part of a business. A bond is you lending money to a company or the government. You are the lender. They give you back a rate of return for lending to them. Well, you could become a hard money lender. You can lend to other people. All of these things are a form of fixed income, which is another asset class. Then we have real estate. Everyone knows real estate, but there's a lot of different ways to invest in real estate. Commercial, land, right? Flipping, the whole nine. Single family residence, right? Apartments, multifamily. Like there's a ton of ways to do real estate, but that is just one asset class. And then you have commodities, which is ownership of physical goods. So whether that's an oil well, whether that's gold or silver, whether that's, right, wheat or corn, right? Any of these things are commodities. Just as I'm talking about this, you probably are thinking like, man, I don't know anything about the corn market. I don't know anything about the chicken market. I don't know anything about, right, the oil market, right? That's why I said you need specialized knowledge to win here. We think we know a little bit about real estate, but that's the only bit of knowledge that we might have. Maybe we don't have knowledge of business. Maybe we don't have knowledge of fixed income. That's part of your work if you want to build wealth. It's not just going to fall on you. You have to learn it. You have to study it. You have to get around people that are doing it so that you can pick up the specialized knowledge and eventually be able to invest in it. Here's the formula. Poor people, right? Poverty-minded people, they use their income to go directly to expenses, and that's it. That's how their money travels. Whatever they bring in goes directly to the expenses and the bills, and they do it all again every single month, every single year until something eventually breaks. That's the kind of the lower end of things. Middle class people think they're better, but they go from income to liabilities. They buy a house, they buy cars, they get student loan debt, they take their income and purchase things that take money out of their pocket, and then those turn into expenses. That's the rat race. That's what people stay in over and over again. Hey, I made a little bit more money. I deserve this car. I need this house, the mortgage, all the stuff. And that just turns into expenses. Wealthy people know the formula. The formula is your income should purchase assets and your assets should create you more income in the midterm. In the midterm, your income purchases assets. Those assets create you more income. Your income purchases these assets that are sitting on the screen. Equities, fixed income, real estate, commodities. You take that and it produces you more income. That's how you build wealth in a midterm investment. I hope y'all are following along because this is how you do it. Again, not the, here's the thing to put $10,000 in and you're going to be rich. This isn't that. I don't know what that is, but this isn't that. This is you learning. This is you getting information and applying this information into your life. That's what we call midterm investments. Then we got our long-term. Long-term is your 10-year nest egg, your retirement, the thing you don't want to mess with, the thing that you say, hey, if all else fails, I know I got some money down there. If all else fails with the risky stuff I was doing and the meme coins and all the stuff that I was playing around with, I know that when I'm 62, when I'm 65, when I'm 70, I'm going to have some money down there. That's your long-term strategy. So with this long-term strategy, you have to pay attention to some things. You have to minimize your tax. You have to maximize your tax advantages. We're going to talk about why that's important. And then you need safety and growth. It's a big misconception out there that you should be risking your money. You should be accumulating a lot of money and risking it all just to get to retirement. Yeah, that might not be the strategy for you. You need safety and growth. You need both. You need to have some protection because who wants to gamble with their retirement? I don't want to gamble with my retirement. I'm not trying to gamble with the future money that I think I want to have.
But I do need to grow. I can't put it in the bank. I can't get 1%, can't get 2%. I got to be able to get 8, 9, 10, 12, 15%. I got to be able to do that. So what do? We have some options. And these are the things that we're going to talk about probably for the next 20 minutes or so, because this is where most people are putting their long-term money, either in some form of a Roth IRA, right? Could be a Roth 401k if they offer it at your job, but typically a Roth IRA. By the way, just slow down, 101. IRA just stands for Individual Retirement Account, in case you didn't know, right? IRA, Individual Retirement Account. So you could put it in some form of a Roth IRA. We'll talk about it. Most people are putting it in some form of a company-sponsored retirement plan, a 401k, a 403b, a 457 plan, a TSP, a traditional IRA, a self-employed person's IRA. Something along those lines is where most of their long-term money goes. We'll talk about why, but I'll tell you, it's because that's where we get our financial information. If we get our financial information from Wall Street, well, all that money goes right back into Wall Street. So they have an incentive for making sure that we put money in those things. But again, we're going to touch on it. There's also cash value life insurance, which we're going to talk about as well. What I want y'all to know, though, is that 401k, 403b, 457, TSP, it's a thrift savings plan, right? IRA, all those things that are tax deferred. There's only really 2 reasons to have them. And again, we're going to talk about this, and I want you to drop questions in. It might be completely different than how you learn money, but it's still the right thing to think about. The reason why you have these is to lower your current tax bracket. Your current tax bracket, not your current taxable income. Your current tax bracket. We'll talk about it. Or it's because you plan to be in a lower tax bracket in the future, meaning you're a high income earner now, and you know you're not going to earn this amount of money when you're in your retirement in your latter years. Those are the specific reasons to be inside of those products. Those are the really only reasons to be inside of those products. If you are not lowering your current tax bracket, meaning you're going from a 30% to a 28% by putting money there, or you're going from 33 to 30, or you're going from 28 to 25, if you're not lowering your tax bracket, or you don't plan on having, right, making less in the future, probably shouldn't be in there. But let's talk about it, because we got to pick something, because we got to put some money away. Here's some things you need to know. 2 strategies or 2 concepts I give everyone when you sit down with us. One is how your money grows. How your money grows. So there's 3 ways that your money grows. These are your only options, ladies and gentlemen. Money is not complicated. We just don't have the information around it all the time. 3 ways: fixed, variable, and index. Fixed gives you 1 rate all the way out. You get a CD at the bank, they give you 2%. That's all you get. No matter what the market does, good, bad, indifferent, you're going to get 2%. Very safe. No way to grow a lot of money, though. Everything else we know is variable. We just looked at it. Stocks, bonds, mutual funds, 401ks, IRAs, all the stuff. It's variable. It means your money is invested in the market. When the market goes up, you make money. When the market comes down, what happens? That's right. You lose money. You got it. You know it because you've probably felt it if you've been in any of these products. Some months are good. Some years are good. Some years aren't good. The question is, do you want to gamble with your retirement? Not that there's anything wrong with it. There's a place for it. More in the midterm than maybe in the long term. But you got to understand where your money's going. The other side is an index strategy. If you haven't heard of it, we're going to talk about it tonight. An index strategy actually gives you the best of both of these. It says, hey, how indexing works, it says we're going to give you the gains of the market up to a certain point typically. There's some products that might give you all of the gains of the market minus a little, right, fee they take off the top. But most of them give you the gains of the market up to a point. 10, 12, 15, 20%, whatever it is, up to a point. But the best part of the index is it gives you a floor. So when the market drops, when the market comes down, they lock you in. It could be anywhere between 0 and 1%, depending on the company, depending on the product. But at the end of the day, you have protection on your money. Market goes to negative 20. We hit a massive recession and people's 401k turns into a 201k like it did in 2009.
Not you if you were in index strategy. If you were in a product that had an index, you got a floor. So you don't have to worry about that. And you still get gains of the market. So if I showed you this and said, hey, where would you want your long-term money to be? Where would you pick? You don't have to say it. It's kind of self-explanatory. I'm sure you'd pick index. But if not, right, we'd figure it out. Deanna says it, right? That's right. Number 3, the index side. That's where we would go. So that's understanding your options. That's what we're doing tonight. We're showing you your options. Here's the other thing to understand. Taxes are your largest lifetime expense. Okay? Taxes are your largest lifetime expense. Why? You get taxed when you make money. You get taxed when you spend your money. You'll get taxed when you save and invest your money. So no matter what you do with the money, Uncle Sam has to get his part of it. If you are focused on building wealth or you're focused on getting ahead financially, you need to have a proper strategy for how you are going to handle taxes, for how the money comes in and how you handle taxes. And then when you go off to invest your money, how the taxes work on that side. You need all of the education to create a strategy for yourself. So when it comes to the investing side, there's 3 tax buckets. There's tax now, there's tax later, which is known as tax deferred, and there's tax advantaged. These are the options. There's nothing outside of these, right? This is it. So once you learn it, then you figure out where you want to be and where you need to be according to your financial life. So we got tax now. That's everything that you know that's in the bank. Savings accounts, CDs. It can even be people that trade stock or trade cryptocurrency, any of those types of things. They're taxable events. So what does that mean? That means every year after you've gotten your interest, they're going to send you a 1098 form that says this is how much interest you made this year in your savings account, and you got to claim that on your taxes this year. So people that love to just keep their money safe, I know people that have 3, 4, 5 different CDs, and they layer the CDs. So, right, you got a 6-month and a 12-month, and you just put it all in CDs. Well, every time those CDs mature, you got to pay taxes on the growth of that money, that tax year. This is why wealthy people don't trade a lot of stock. They buy and hold for a long period of time. They don't use a lot of bank instruments because there's no tax benefit in it. And so if you want to win the money game, you got to win the tax game. And so by putting it in the tax now side, you got to pay taxes on that every year. Then you got tax deferred. That's what we just looked at. 401k, IRA, TSP, 403b, 457 plan, all of those deferred compensation plans at your job, all that stuff. It's tax deferred. What does that mean? That means I'm not paying taxes on the money now. When it goes into my 401k, I don't pay any taxes on this money. But down the line, when I'm ready to pull money out, I'll be taxed at whatever my tax rate is down the line. That's what it says. So if you think of your check, many of you have a job, you got gross pay, they take out FICA, Social Security, disability, all the stuff, leaves you with net pay, right? From gross pay, you're putting money into your 401k, 403b, IRA, those things. Then that money grows, you grow a larger portion of money in there, hopefully. And down the line, when you're 60, 65 years old, you're ready to hit retirement, Uncle Sam is going to tax you at whatever the tax rate is when you're 65, when you're ready to pull out that retirement. Ladies and gentlemen, I know you're very smart. That's why you're here. You think taxes are going up or are they going down? What do you think? Again, you can answer it in the chat, but I think you know the answer. Is the government going to want more of our money down the line or less of it? They're going to want more. Right? They're going to want more of the money. That's exactly right, right? They're going up. So if you know that, if you know taxes are going up, does it really make sense to say, I'm going to not pay taxes on this small amount of money I put into my 401k when taxes are arguably the lowest they'll be in my lifetime? What I choose to do is grow a larger portion of money and down the line, pay taxes on it when taxes are potentially higher. Doesn't make sense, does it? Not too much. But they kind of sold us on the fact that you should put money in a 401k. You should put money in your 403b. At least you're saving money, right? They try to sell us on that fact. I'm going to give you the numbers after this as to why it really doesn't work. And you got some of you are going to be blown away to understand that. And again, I know this might be completely different than what you were taught, but that's why we do this. Very similar to us jumping on last night with Adrian. And she's like, hey, I know we just haven't been taught about this type of stuff. And I know there's just stigma around it. Got it. So let's just get the education and then we can figure it out from there. So that's what tax deferred looks like in those tax deferred products. The other side is tax advantaged. That's the opposite of tax deferred. That says, hey, I'm going to pay my taxes now on this bit of money that I'm putting away. But down the line, when I go to pull that money out, there's no taxes on this thing. I'm not going to pay any taxes on it. So we have to choose where we'd want to be, tax now, tax deferred, or tax advantaged. Again, for your long-term money, you get a chance to pick. No one forces you to put money anywhere. It's your choice. Once you're educated, you pick the right thing for you and your family. So whether it's tax deferred or tax advantaged, or whether it's variable or index or fixed, you get to choose. We're giving you your options. You might already know where you want to be. You're like, hey, I think I want to be indexed and I think I want to be tax advantaged. Okay, well, there's an option there. We're going to talk about it. It's called an IUL, an Index Universal Life product. We're going to talk about it. The Roth IRA is very popular. I didn't put this in today's information, but let me give you two downsides to the Roth IRA, because we know the upside is that it's tax-free money, right? It's tax-free down the line. Here's two downsides for you if you didn't know. Number one, you can only put away $7,000 a year if you file single, right? It's like $15,000 if you're joint, right? But $7,000 a year, it's the most you could put away as an individual inside of your retirement account. Now, I don't know, one day you might want to put away more than $7,000 a year towards your retirement. One day, you might want to. But you can't do it in that vehicle. You can't do it in a Roth IRA because they're only going to let you put in $7,000. Here's the other side. If any of you want to go earn more money and make more money, there's an income limit. If you make more than, I believe, and these numbers change every year, if you file single, it's like $128,000 a year, adjusted gross income. If you file jointly, if you're married, it's $189,000 a year, adjusted gross income. That's what you file on your taxes, adjusted gross income. If you make more than that, you can't even put money into a Roth IRA. Bet you didn't know that. Can't even put it away, right? So some of you aspire to make more money. And one day you're going to get to that place where you and your spouse and your significant other are bringing in $210,000 a year household income. Well, guess what? You can't put money in a Roth IRA anymore. They're going to force you to either put it tax deferred, or you can have this conversation about cash value life insurance, which they call the rich man's Roth. It's the way to get away from the taxes and be able to put more away once you're educated on it. It doesn't fit everyone, but for the people that have the room and want to put away more for retirement and keep it tax-free and secure it, it could be a good product for you. You just got to know what your options are and where you sit. Here's a question for you, though. Are you or someone you know currently contributing to their 401k, 457, 403b, TSP, deferred comp plan through your job? Drop a 1 in the chat if you are, or you know someone that is. Drop a 1 in the chat if you are contributing to your 403b, 401k, 457, or you know someone close to you that is contributing to these things. Drop a 1. We got a few people dropping 1s in there. These are the premier financial vehicles that most people use from their job, right? Sharonda says she is, got it. We got 1s dropping in the chat. Good. So that means you know people that are doing this. So this is going to apply to you. By the way, quick pause. Share this with somebody that you know right now. Share the live. Share the link. Hey, they're about to talk about some 401k. Aren't you putting money in a 401k? You should probably jump on this thing. Probably going to learn some stuff. Send it to them. Don't just take and hoard the information. And if you do get the information and then you try to go give it to them, they might not believe you. They might not listen. They might be like, oh, well, what about this, this, and this? And you won't know how to answer it. So just send them. Get them on. So if you know someone, this is going to benefit them. Let's break this down. We've done extensive education around 401ks, deferred comps, all these types of things. And while we're not bashing these things, we have to understand what the proper usage of them is for. That's all. Remember, you'll hear me say this over and over again. There is no one financial product that is good for everyone, okay? So if everyone at your job has a 401k and all of you are using it, that means it's not good for somebody in there. We don't know who it is, but somebody, that's not the right plan for you, because all of our financial life is different. All of your financial goals are different. You have different things you want. So for them to say this one vehicle will help everybody get to where they want to go, they are misinforming us. It's not the way finances work. It's individual to the person. So yes, they do work for some people. I kind of already mentioned who they are: high income earners and people that need to lower their tax bracket this year. That's who they really work for. Outside of that, we have to now debate, is this really the best thing for us? Let's dive into this stuff though. Again, good note-taking time. Might want to record. I don't know, right? This is really good information. I was putting this together. I was re-looking at it earlier today, and I was like, man, this is solid. Like, I wish I knew this stuff, right, a long time ago, but now I just get a chance to teach it. So it's all good. Hey, your 401k retirement plan, it's America's premier retirement vehicle, just like your 403b, 457s, all those things. But did you know there's an article, the guy that came out with the 401k said he created a monster. He was like, yeah, I don't like, this wasn't how it was designed. He basically was like, yeah, I don't think this is how it's supposed to work. This was an excerpt from that article. He said, but like many critics in recent years, he began to think, the guy that created it said that 401ks might not be the right thing. He created a monster that should be blown up. This was back a decade ago. This was 2011 that he was thinking these things and having these conversations with people. Another excerpt from here says, in fact, the original purpose of Section 401-K, did you know that it was just a tax code? Did you know? I don't know if you knew that. I thought maybe you thought they just designed the name somehow. It's actually, right, the 401-K section of the IRS tax code. That's what it's for. And it says here, it was designed, right? The purpose of the Section 401k was to limit the use of executive cash deferred plans. The 401k's big regulatory hurdle, and perhaps its biggest marketing hurdle, was that administrators technically needed the IRS's blessing to reduce employee wages. They were trying to find a way to pay people less in order to put this money into tax deferred accounts. They were originally dubbed salary reduction plans. Got to know the origin of things before you just start listening to people around you. It's where they came from. They came to just reduce your salary because they said they match you, right? We'll talk about it. We'll talk about it. But anyway, it says the plans had grown so overcomplicated and so fraught with hidden fees and opportunities for bad decisions that they were better at enriching the financial industry than the actual savers. Wall Street is winning because there's trillions of dollars of 401k, 403b, 457, TSP money sitting in the stock market that you don't get to touch. They get to play with your money. They get to touch it. They get to do what they want with it. They get to change the funds. They get to borrow against it. Like the biggest corporate, right? The BlackRocks, the hedge funds, right? Like them. That's who we turned the money over to when they sold us on this 401k that just came out 1981. We're literally going on 45 years of this experiment. It hasn't been forever. It came out in 1981. So much so, they put it on the cover of Time magazine a couple times. This was back in 2005, the Great Retirement Ripoff, right? Talking about people's 401k. Came back around like 4 or 5 years later in 2009. Why it's time to retire the 401k and what you can do instead. They put it on the cover of Time magazine. They always say though, right? If you want to hide something from people, put it in a book. People don't read, right? You want to hide something from people, put it, like, make people read it. They won't. They won't. So these things just kind of, we just kind of blow past it. But now here we are. So let's teach about this 401k thing. Okay? Let's understand, if you are putting money there or you know people that are putting money there, you have to understand it. Rule number one of any form of investing, ladies and gentlemen, is know your investments. Know them inside and out. Those of you that have sat down with us or, right, you're here in the business with us, you know we ask this question. If you know someone or you're invested in a 401k, I ask you the question, hey, scale from 1 to 10. 1 being not at all, 10 being you're an expert. How well do you understand your 401k? Most people say a 5 or below. That's what most people say. No matter how much they have in there, how much they don't have in there, how long they've been in it, doesn't matter. Everyone's pretty average. I know it about a 5. If anyone, I could probably count on one or two hands the amount of people that have told me above a 5. And then I'll ask them, then why do you put money there? If you really know at a level 8, a level 9, you really have to convince me that, like, why would you put money there? Knowing what I know about one, you probably wouldn't want to have one, but if you do know about it, then why do you want to put it there? And so we get into those things, but this is the stuff you need to know about your 401k. One is called the 59.5 rule. Okay, the 59.5 rule. This is for all tax deferred products, everything that was on that list. 401ks, 403bs, IRAs, 457 plans, deferred comps, TSPs, all the stuff. Okay, deferred plans. There's a 59.5 rule. 59.5 rule says if you choose to touch the money inside of this account before the age of 59.5, the government's going to hit you with a 10% penalty. So literally, by putting your money into it, whether you are 19 years old and you put money into your 401k, or you're 49 years old and put money into your 401k, you got to wait until you're 59.5, 60 years old to touch that money without penalty. If you choose to touch that money anytime before you turn 60 years old, the government's going to take 10%. The government knows this, by the way. This is how they get extra of your money, because they know what's the likelihood. You know how much we convince kids, younger people, to put money in their 401k? Government knows what's the likelihood that someone has a financial hiccup between the ages of 20 and 60. Come on, guys, right? Like, what's the likelihood that you lose a job, that you get sick, that something happens, that you need to touch the money that you've been putting away long-term over a 40-year window? It's highly likely. Well, every time you touch it, the government takes an additional 10%. So for everyone because there's a myth out there like, oh, it's just a savings account. It's a savings account where you'll lose your money if you keep touching it before the age of 60. If every time you switch a job and you got to cash it out, like, the government knows that. They're taxing you by just the penalty. Not to mention the money hasn't been taxed. So we got a 28% federal tax if that's your tax bracket. 9% is an average state tax. Maybe you live in a state that doesn't have state tax. That's okay. But either way, if you do, there's state tax. And then there's about 2% in fees inside of most deferred plans, right? Just as it's coming out, as you're withdrawing money, there's probably about 1 to 2% in fees. So today, if you want to take money out of your 401k, 403b, 457, all that type of stuff, the government's going to take 49% of that today, right now. So whatever you got in there, if you look at that balance that comes, you're like, I got $100,000 in my 401k. Technically, you have 51,000 because the first 49 is going to go to the government because you haven't paid taxes on it. And that's today. I hear someone out there saying, well, I don't plan to touch it until I'm 60. Great. Question, what are federal and state taxes going to be when you're 60 years old, Mr. and Mrs. Person? If they each go up 5% by the time you hit age 60, well, we're right back in the same ballpark. And considering that our country's $39 trillion in debt, the likelihood that they go up 5% over the next 10, 15, 20 years is highly likely. So you're still sitting in the same spot. So these are just things we got to know. Once we get into that bucket, you can't get out of the bucket. Once you're in tax deferred, this is what you've done with your money. That's why it's good to be educated on it before we do things, not just because we heard that this is the right thing to do. If you're already in your 401k, guess what? You can't take that money until you leave employment, until you get fired or you quit that job. That's their account. You had to get it through them, so it's theirs. The only thing you control is how much you contribute to it. You can't touch any of that money. If you take it, you're borrowing it. You can't withdraw it unless it's a hardship, but we'll go down that path, right? That's the 59.5 rule. Got to know that. That's your actual retirement amount. It's after taxes. Just know you can contribute $23,500. Why is that number, right? That's like almost $2,000 a month. You know, the average person puts away anywhere from $100 to $400 a month in their 401k. Like the average person. There's not many people that are putting away $2,000 a month, but that's who it's designed for. It's designed for the people that make $180,000 a year and want to lower their tax bracket. So they're like, well, let me put 23,000 over here into this tax deferred product. So instead of it looking like I made 180, it looks like I only made 157, right? My math, right? It's a math class tonight. It looks like I only made 157 because I put 23 over there. But if you make 70 and you put away 1,200 because you put away $100 a month, or you put away 2,400, or you put away $3,600 a year, that's $300 a month, and you made 70,000, it's going to look like you went from 70,000 down to 75, 70, 76, 4, 66, 4 numbers, right, man? 66, 4. You guys know what I'm saying. But either way, that's the contribution limit. And that's what you can put in. Most people don't get close to it, but you got to still know that's the limit. Here's the other side to the 59.5 rule. It's something called the 72.5 rule. Maybe you did hear of the 59.5 and you were okay waiting till you're 60 to touch that money, even though you probably already touched it once or twice and you already got hit with your 10% penalty. We're just going to keep doing the same thing. But the other side is the 72.5 rule, which a lot of people don't know about. The 72.5 rule is the opposite. It says, hey, let's say you did everything else right. Let's say you got your short term, you put your long term over here in your 401k, you started building in the midterm, you got some real estate, you got some investments. Like, you don't even really need this money. You can let it just grow. Well, the IRS says, hey, if you get to age 72, almost 73, and you haven't touched any of this money, we need our money. We're not just going to let you not pay taxes on this money for your entire life. We need some of that money. So at age 72.5, if you haven't touched any of your money, they're going to require you to take money out. It's called RMDs, required minimum distribution. You'll get a letter from the IRS. It'll have a percentage at age 72 of exactly how much you need to withdraw just to satisfy your RMDs. You don't have to take out all of it. You just got to take out whatever the IRS requires you to so that they can tax you. This is literally, right, the other side of the rule that says, yeah, if you do everything right, we still need our money, right? Like, you still need to pay taxes on this. If you said, you know what, IRS, I really don't want to do that. I'm not a fan of this. This is not what I want to do. I'm going to keep this money in there. There's a rule. You can read this. You can read this. I'm just delivering the information that says, right, if you choose not to do it, you're going to get hit with a 50% penalty. Literally in the tax code, it says if you don't use it, you'll lose it, right? If you made it, you're 73, you're 75, you're like, I'm not touching this money. You're going to get penalized 50% every time you start taking that money out because you haven't satisfied your required minimum distribution. So you got a window of time to use the money that you put into these tax deferred products, 401k, 403b, IRA, 457 plan, TSP. They all work the same. They just got different tax codes because they're given to different industries. That's all. They're given to different people. They're basically all work exactly the same way. They just nonprofits, right? Medical field, teachers, right? Military, they all do something a little bit different, but they're all really the same thing. 72.5 rule is something a lot of people don't know about, but you got to be educated on it. Here's a big one, market loss. We looked at what it means to be variable, but if you see this chart down here, this is the actual S&P 500, right? The US stock market, the top 500 companies in the US stock market. If you see the way the graph goes, it starts from 1996 all the way to the end of last year. Just look at it, right? Again, you're very smart people. Just take a look at that graph. I know there's a bunch of people on the internet and a bunch of people that say, hey, invest in the market only goes up, right? Keep putting the money in the market, it'll be there for you. Sure, to some degree, in a midterm example, but in our retirement, in our long term, look at this. Whatever goes up, you know the saying, must come down. 2008, 2009, the crash, our last huge recession that like everyone knew was a recession, was the last time that the market really kind of like hit a bottom. For the past 16 years, we just been going straight up. Sure, there's a few dips here in 2020 and then a little dip in 22, right? But nothing back to the levels of 2008, nothing back to the levels of 2009. And I'm not a magician and I don't have a crystal ball, and that's not what I'm here to do. I'm just here to present information that says everything that goes up has got to come down at some point. We don't know how far it comes down. The question is, when you're ready to get off that roller coaster, can you? When you're ready to get off the roller coaster because it's a little too scary and it's dropping a little too far and we don't really know how far it's going to go down, is your money still going to be there? Is your retirement income going to still be there? Is your 401k still going to be there? Because if you're still working with the job, there's nothing you can do. You can just control putting it in. You can change it to conservative, but you're still going to lose money. So we got to understand that market loss is a real thing. I would educate people on this, that mathematically, write this down if you don't know it, mathematically, it's more important to not lose money than it is just to make money. Say it again, mathematically, it's more important to not lose money than it is just to make money. Okay? I'll give you a quick example. Again, this is a math class. I went heavy math tonight. If I give you $100 and you put it in the stock market, you take that $100, the market goes down 50%. How much you got? You don't have to answer. I'll do it for you. $50, right? Gave you 100, market went down 50, you got $50 left. From there, the market goes right back up 50%. How much you got? Some of you will say 100. It's first thought, right? I went down 50, up 50, I got 100. Not quite. $100 down 50%, you're at $50. If you go right back up 50%, well, what's 50% of 50? That's 25. So that means I only have $75. So net, the market did zero. Down 50, up 50. I went from 100 to $75 in my money, in my actual money. Why is that? That's called the impact of a loss. Mathematically, it's more important to not lose it, than it is just to make it. If we focus on just making it, but then we are losing it, we're going to end up about at the same place. That's why the stock market gives back about 5, 6, 7% over the long haul. That's why. It's because one year it's up 20, and then it's down 15, and then it's up 7, and then it's down 12, and then it's up 40, and then it's down 15. Like, it all is going to even out to 6, 7%. You got to know this about your money, ladies and gentlemen. Lastly, it's 401ks have a ton of fees inside of there. I don't know if you know this, but there was an article written, it was a Goldman Sachs review. It said, according to a survey from TD Ameritrade, 37% don't believe they pay any fees inside of a 401k. There's almost 4 out of 10 people are like, yeah, there are no fees inside of mine. 22% didn't know about the fees, and 14% don't understand how to determine what fees they pay. But 95% of people in 401ks incur fees and charges. What are the fees? Investment fees, plan administration fees, individual service fees, transaction fees. Everything that you invest in inside of your 401k, 403b, 457 plan, TSP, is a compilation, like a collection of stocks and bonds. You're probably in about 400 to 1,000 different investments inside of there. And each of those investments has a specific amount that they have as fees inside of the investment. You might not see it on your actual like 401k statement, but inside of it, with all of the actual what's the word I'm looking for? All of the the investments that are inside of there, right? The mutual funds or whatever they are, each of them has their own set of fees inside that get masked by the 401k. The recent study from the Center of American Progress found that the typical American worker who earns a median salary starting at age 25 will pay out about $138,000 in 401k fees over their lifetime if that's their investment vehicle. $140,000 almost in the lifetime will just go to fees with no other benefits. It's just you had the product. Cost is even greater for high income earners. So you got to know these are some things to pay attention to. These are the things to understand: the 59.5 rule, the 72.5 rule, what your contribution limits are, how's tax deferred work, how do you get the money out, what types of fees are inside of there. This is the important stuff you got to pay attention to before you go and start putting money in. If you've already put money in, well, guess what? We got to figure out some things. These were the numbers that I told you, if they make sense to be tax deferred. Put these numbers together, and again, it's the reason why finance works, money works, investments, those things, is because it's all rooted in numbers, and numbers are rooted in facts. So this is not opinion, right? You can get to the numbers of what's going on in your financial life. Here's the best case scenario. There's 3 stages to retirement. There's the contribution phase, the accumulation phase, and the distribution phase. How much are we contributing? How do we grow it? How do I get it out? That's what you should know. How are we contributing? How do we grow it? How do I get it out? That's what you got to understand about your money. So this is an ideal scenario. You are in a 401k. You put $250 a month into your 401k. That's $3,000 a year. Again, average person would do something like that. Now, if you chose to not put it in there, you would get taxed on this money. Let's just say you get taxed at a 30% tax rate. There's even numbers, okay? You would have gotten taxed on that money. So literally, you're saving about $900 a year in taxes. That's what you would have paid if that just hit your check. You'd have paid like an additional $900 that year in taxes. So over a 30-year period, that's $27,000 that you saved if you just did $250 a month, okay? Follow the math, right? I know this wasn't math class, but follow the math. $900 a year saved in taxes. So over a 30-year window of you putting into a 401k, you'd save about $27,000 over the lifetime of the taxes you had to give to the government at that time, okay? Now, let's say you start accumulating. Let's say you get your one-to-one match. Everyone loves a match, right? Call it the American trap, but everyone loves a match. So you put in $3,000 a year, your company matches you another $3,000 a year. Got it? Let's say you do that for 30 years, and let's just say, best case scenario, you make 9% interest monthly. That's a pipe dream, right? Like, I don't know anyone that's ever done that. But let's just say that was the case. You made 9% interest monthly all over these 30 years. You'd have a balance of $922,000 sitting inside of your tax-deferred 401k, 403b, 457, whatever it is. That's your ideal scenario. That's what most people are trying to get to. Man, if I get to $1 million inside of my 401k, things would be good, right? Wrong. Here's distribution side. Let's say you did round it up to $1 million. Say you rounded up to $1 million. That's what you got. Now you're 65 years old, right? You passed your 10% penalty of getting out. So you just got to pay taxes. And let's say you want to take out 5% a year. You just want to take 5% a year. That comes out to $50,000 a year that you take. Let's just say the taxes stayed the same. Let's say the taxes never went up over 30 years. And you kept the same $30,000 in, right, or 30% tax. Well, of that $50,000 that you withdraw every year, you're paying $15,000 a year on those taxes. Like, you have to pay that now because you're distributing that money to you. If that money's going to run out in 20 years, and you would have paid $300,000 to the IRS. Now, sure, you had $1 million and you only paid $300,000. I get it. You still had $700,000 that you made, right, by going this process. That could still work. The difference is, though, you paid $300,000 to the IRS, and you only saved $27,000 on the front end. So, is there a better method for you to getting to that place where you don't have to give $300,000 away to the IRS? This would be the equivalent of you maybe getting $500,000 or $600,000 in a tax-advantaged account, because then you don't have to worry about paying the taxes on it. So again, knowing the numbers, understanding what happens when you contribute pre-tax, what the goal is to grow a larger portion of money, and then what happens when you distribute that money, you're going to wind up paying taxes, and that's saying if the taxes didn't go up. And that's saying if you only took $50,000 a year. There's a bunch of things that come into play with this. There's a bunch of things, right? Shonda, I see that question. Great question in the chat. It says, can you transfer your money from a 401k? Great question. If you do not work, there's 2 ways to transfer money out of your 401k, right? Like move it. One is if you no longer work with the company. If you get fired or you quit. It's the only way to say, okay, now they relinquish that money to you. Now you can figure out what to do with it. You don't have to withdraw it. You can move it into a different product. You can just not pay the taxes yet and move it into an annuity or something. But that only comes after you leave employment, after you quit or get fired. That's the one time you can withdraw, like actually take your money with you. The only other time is something that's special to a company. It's called an in-service rollover. An in-service rollover means you're over the age of 55, currently working for your employer. You're over the age of 55, you're currently working for your employer, and your employer says, we will allow you to do what's called an in-service rollover, meaning you can keep your job here, but you can take your retirement and roll it into something completely different. That only comes with specific companies, like not every company offers it, and you have to be over the age of 55 in order to do that. If you're not over the age of 55 and your company isn't offering that, then the only way to transfer that money of your 401k, 403b, 457, TSP, any of those things, is if you leave employment. That's it. Okay? Hope that answers the question. Like I said, while you're still working, the only thing you can control is how much you can contribute. Like after hearing this, you can go to HR tomorrow and be like, hey, lower my contribution to 0. And they'll put all your money back on your check. And then we figure out what to do from there. But the money that you have sitting in that 401k is going to sit there until you leave employment or get fired. That's the way it goes. Okay. So you got to know contribution, accumulation, distribution. The proof is in the pudding. Here are the numbers. I pulled this off of the Empower website. Empower is one of the brokerages, right, that has a bunch of these 401ks. As of the end of last year, y'all, these are the averages and the medians inside of their 401ks. Again, a little math lesson. Averages, right? Averages is you take the total amount of people, right, that are inside of this, right? The total number, you add up all of the monies that they have and you divide by the number of people. So if you got 100 people inside of your 401k, like their 401ks, you add up all of the balances inside of those 100 people's 401k and you divide by 100. That's how you get the average. The median is the middle. It means you have 100 people inside of a 401k. Half of the people have less than this amount. Half of the people have more than this amount. So 50 people have more than this. 50 people have less than this. That's the difference between average and median. Let's look at the median numbers, because if we're trying to impact the masses, then we got to know that half of the people have less than what we even see on the screen. So it goes by the ages. People in their 20s, the median 401k is $34,000. That means half of the people in their 20s have less than 34 and half the people have more. In the 30s, 73,000. Half have less, half have more. Here's where it gets kind of crucial. 40s, 50s, 60s, and 70s. 40s, 154,000. Half of the people have less than 154, half have more. In their 50s, $250,000 is the median 401k. Again, you heard me say this on a clip. If you guys were here at the very beginning, I said, imagine you're in your 50s. You're at the height. You're 59 years old. You're at the height of your career in the monies that you make. Let's say you make $100,000 a year. Finally, you're 58, 59. And half of the people around you have saved up 2.5 years worth of retirement. 2.5 years. And we don't have a long time to keep working. We're in a retirement crisis. These are the numbers. In their 60s, it's 210,000 is the median. Half have less, half have more. I just responded to somebody on TikTok today that was in her late 50s saying, I got nothing saved for retirement. I got nothing going. Like, how are people making it? How am I supposed to make it? I don't have anything. I raised 5 kids. I did all this, blah, blah, blah. I'm now 50, 58, 59. I got nothing. This is where we're standing. So again, these are people that said, I'm going to put money into this 401k thing. Question is it playing out for people in the right way? Like, is this helping people? Is this getting people to their financial goals and dreams, or was it really just an experiment that started in 1981 that was really trying to just get companies to pay you a little bit less and put more money into the stock market for you? And now the people that are losing are the people that said, hey, I think that's the way I'm going to go. Again, I don't know, and I'm not here to convince you one way or the other. It's just this side gets glossed over. We hear of all the positives, but we don't talk about any of the downsides. Coming up probably in the next few months, we're going to talk this same conversation around home ownership. We talk about all the good things, but have we ever talked to people that have lost their homes, that it just got it was unmanageable, that they had a financial hiccup, that they became house poor, right? Where all their money was going to their house, and how much of a stress that was, and all the stuff. Like, do we talk about that side? Not that we're glorifying either side, but we have to get a very real perspective of what we're in for financially. So again, this is some things to think about when it comes to your 401k. Here's some solutions, y'all. Here's some solutions. If you're under the age of 45, just know if you're under the age of 45, you got to just understand the difference between short, mid, and long-term investments, right? That's what I took you through. You got to understand the difference between where you're putting your money, short-term, what mid-terms look like, and what long-term look like. You got to pick some reliable vehicles and stick to them. Educate yourself and then start doing those things. Take advantage of compound interest. 46 to 55, I call it game time, right? It's game time. You got to have a detailed plan. You got to take it serious. You got to know, hey, one day you want to retire and it's coming up sooner rather than later. So we got to put together and organize a strategy to make sure you hit these retirement goals. We got to start calculating net worth and, right, putting a heavy focus around that midterm and where we choose to sacrifice. Like 46 to 55 is game time. And so we got to make it happen. 56 to 70, you're in your retirement red zone. Shout out to the Eagles. Go Birds. Go Birds. Retirement red zone, though, right? You're entering the fourth quarter. You're trying to land the plane. And landing the plane is the most crucial step. We get information on how to contribute and how to accumulate, but they don't tell us how to land the plane. They don't tell us how to distribute it out. They don't tell us how to pay less in tax. Like they drop us off, and you got to learn how to land this plane yourself. So coming out of the accumulation phase into distribution, you need planning. You need to work with someone. You need to work with a financial professional. You need to talk about your options. You need to see what's available for you because you're in the red zone. Time is of the essence. We got to learn how to protect that money. We got to avoid the taxation. Most importantly, we got to think about not outliving that money. Last thing we want to do is go back to work when we're 75. And that's what's happening out here. Luckily, you're on calls like this. Luckily, you're introduced to people that can introduce you to the people that know the stuff so you can get the help you need and your family if they need it as well. But you got to understand that's where people sit. Here is how you prioritize this conversation before we dive into the next part. Here is how you prioritize this. Your priorities, ladies and gentlemen, when it comes to short, mid, and long are short-term first, long-term next, mid-term last. Short-term savings first. That's 6 to 12 months set aside in your emergency fund. You've got to master getting there. Before most people, and this is why we do this, because most people will start investing. They'll start their number 3. They'll start their crypto, their stocks, their real estate. They'll start that before they've mastered number 1, before they have 6 months of income set aside, before they've learned how to earn it and save it. They're off investing it because that's what they heard and that's what they think they should do. There's an order to this operation. If you want to build wealth, you got to learn how to save it first. Inevitably, I work with too many people, y'all. Inevitably, what happens is if you do this out of order, if you don't focus on short and long and you play in the midterm because it's exciting and it's flashy and that's where you can make it big and hit it and all the stuff, your foundation is weak. You will sell those investments. You will not keep your midterm investments. You won't. The goal of investing is to keep investing and to not have to touch your investments. That's the goal of investing. Every wealthy person will tell you the reason why they get wealthy is because they're not in dire need to sell their investment for extra cash flow or because the toilet broke or because they had a job interruption. That's not why they're selling off their investments. They're selling it because it's at the height, right,
They bought it low, they're selling it high, they're taking their profits, they're moving it into another asset class, they're doing it all over again, but they're not worried about their 6 months of income in the bank. They have that. That's what you got to focus on. Short term, six to 12 months. Master that. Then get in the habit of putting away $500, $1,000, $2,000, $3,000 a month for your retirement. That's your long term. What I say, if all else fails, you know you got some money down there. You got to supercharge those two things before you even think about putting money in the stock market, before you even think about playing around in real estate, before you even think about playing around in equities or all these things. Like you gotta master this stuff first. And this is where most people get it out of order, because Warren Buffett says this quote, right? That it's most people never build wealth because building wealth is slow and boring. And most people want their investments to be quick and exciting. So when we're seeking that dopamine, that gambling hit, that, ooh, I made it big, when we're seeking that, it's literally the opposite wiring we need to actually build wealth. Building wealth is brick by brick, little by little, good habit by good habit, continuing to stay consistent, learning the fundamentals. When I'm athlete, right? When you're in the gym, you don't start by shooting 3-point shots when you walk in the gym. You start by layups. You start by shooting close to the basket. People get impatient with their money and think they can start shooting half-court shots and hope that they get it. It's the opposite of building wealth. You've got to master short-term savings. Get yourself to 6 months. Guess what? It might take you a couple years. Money's not going anywhere. Investments aren't going anywhere. Don't have FOMO. You're not going to miss out on the thing. And if you do miss out on the thing, the good thing to know is markets are cyclical. So every 7 to 10 years, it's going to come right back around. And so you might have an opportunity to catch it on the next one as long as you're getting your short-term good. Then you got to get your long-term good. You got to find a place to put money, grow your compound interest. You got to do that. Then build specialized knowledge. That's the thing you can be doing in the current to help with your future midterm investments. If you're putting money short and long, learn about the asset classes, study equities, study the market, get a skill set in trading, learn real estate, learn commodities, learn it. Don't put money there, learn it, study it. Take 10 hours a week, watch YouTube videos, read, get in Discord channels, get around people. Like study your midterm while you're doing the right things short and long. Once you reach your short-term goal, this is why this is important. Because once you find a way to get you 6 to 12 months, stop putting money in the bank. You know, they say you can't save yourself to wealth. That's not what you're doing. You're not trying to save yourself all the way to becoming wealthy. You're trying to have some security so you can continue to invest. When life's emergencies pop up, you don't have to touch your investment. You don't have to sell off the house at the wrong time. You don't have to miss out on the gains of the market because you really needed some cash right now. That's how you play the game. You win 1 and 2. Once 1 is good, you get to 6 months, you're like, I'm not putting another dime in my savings account. I got 6 months of my income, I'm good. All the rest of your money goes to long-term and midterm. Here's the quick secret before we move on. The best midterm investments are hefty 5 to 6 figure investments. The best midterm investments. I talked to you about midterm, right? Asset classes, stocks, bonds, mutual funds, all the stuff. The best midterm investments are 5 to 6 figure investments, meaning you got $30,000 to put into an investment. You got $110,000 to put into an investment. Those are the best midterm investments. When you can pay $70,000 for a business, for a piece of real estate, to invest in somebody's startup company. If you invested $25,000 in the startup round of Uber, after 7 years it goes public, you would have made $7 or $8 million. 25,000 turns into 7 million in a midterm investment. But that's because you had 25,000 to put there. You weren't putting 100, 200, 300. That's short and long stuff. You put your $200, $300, $400, $500 in your short term and in your long term. When you get to midterm, you're playing with the big dogs. You're trying to build wealth. So you have to accumulate it and then know where to put it from your specialized knowledge. That's how to win the game. I know it's not sexy. I know it's not quick,
I know it's not what everyone is teaching, but that's the proper way from many wealthy people that we've studied, that we've talked to. That is the way. It might take you longer. You know how you speed this up? Go back to our conversation yesterday on raising your cash flow. That's how you speed it up, because you got to have more to put away. It's a lot different if you're saving $300 and $400 a month than if you're saving $5,000 and $7,000 a month. It's a lot different. You'll get there a lot quicker. But that's what you got to know about investing. Don't let anybody tell you anything different. Here's what most people look for in their long-term investments. They're looking for no taxes. They're looking for high rates of return, and they're looking for low risk. I'm sure most of you would agree with that. Shauna said investing in crypto. That's a midterm. That's midterm. Again, I'm glad you touched on it. You know why? Because media runs everything. Another Warren Buffett quote. I love listening to Warren Buffett because he's the most successful investor of our time. Right? Most successful investor of our time. Success leaves clues. So you can always pick up information. He says, be fearful when most people are greedy. Be greedy when most people are fearful. That's been his investment strategy, and he's one of the best investors of our time. So when the media starts pumping a bunch of things, when things become very popular and people become greedy and they start pouring more money in, that's your time to be fearful and be like, yeah, I don't know about that. When it's time, when people are fearful, when they're like, I don't know, oh, it's all bad. That's when you're greedy. You're like, okay, where's the opportunity? Where should I look? Cryptocurrency is a midterm investment. It's a 2 to 10 year. Now, I've given other people this strategy to say, hey, if you want to treat it like gold, treat it like gold. Buy a little bit for the long haul and just don't touch it. Don't break the bank, right? Buy $50 worth of Bitcoin, $100 worth of Bitcoin over and over again. Don't worry about what the market's doing. Just like if you were to buy gold, like you're not worried about what the gold market is doing. You're literally just doing it to pass down some money. You got some set aside. You're not putting your whole budget on it, but like you have a little bit of it just in case something happens down the line. Sure, you can treat cryptocurrency like gold. You could do that. If you are trying to hit it big and trading, that's a midterm skill. That's a midterm investment. You should not be doing that unless you have 6 months of income in the bank and you have long-term setup. That's when you start playing with crypto. That's when you start saying, and again, you study it up until that point. Up until the point that you can get yourself 6 months income set aside and you're putting away $300, $400, $500, $1,000 a month into your long-term retirement, just study it. But see, when we start studying it, we get FOMO, right? We feel like we're going to miss out on something. We feel like everyone's doing it and we're not doing it, so we don't want to miss out. Like, this is where, I said it yesterday, again, if you can't control your emotions, you can't control your money. If we're wrapped up by what other people are doing, it's not going to end well with our money. And that being said, it could be a very, right, like viable way for you to be able to make money. I'm not saying it's not a way to make money, but you got to have a specialized knowledge. All the people I know that make money in the crypto space, they're knowledgeable. I've been educating myself about crypto since 2016, 2017, right? Like I'm 7, 8 years in understanding it, and we don't even put a bunch of money there. So if you did want to start, then that has to start with knowledge and information and you getting good. And then you got to look at your savings account and be like, hey, am I anywhere near 3 to 6 months? If the answer is no, then don't put it there. If the answer is yes, if you got 6 months income, then that's a viable skill. If that's where the asset class you want to build in, by all means, go do it. Go do it, right? So that would be the answer. That would be the answer. Everybody's a bit different, right? So what most people look for in their long-term investments, no taxes, high rates of return, low risk. What if I could show you a way that you can do all 3 of those? This is when we start diving into some things around the income side, the protection side of things. So a lot of people know, right, your fixed products. The good part of your fixed products is they give you safety. The downside is you don't have a really high return. Then your variable products, you get a lot of upside potential. You can make a lot of money in the market, but you risk a lot of your capital. So what is the best of both worlds? It's these index products. We talked about it. Index strategies give you the best of both worlds. They give you the upside potential and they give you the safety on the downside of things when it comes to your long-term investing. All right. So here's some factors that impact your retirement, your long-term side of things. We talked about market risk. So how much is your money being shielded from the market?
how much of it is risked in the market for your retirement, your tax exposure, which we talked about, taxes being your largest lifetime expense. So how much are you exposed in the tax side? Are you a lot of tax now and tax deferred, or do you have any tax advantaged? And then this is the last part we're going to wrap up with tonight, is going to be the healthcare costs and future health issues, right? On the health side of things. These are the things that impact your retirement. Again, our job is to help you build a foundation financially. So if you need a foundation, you got to know the things that could erode that foundation. One of the things is market risk. The other is high taxes. The other one is your health, right? It's your health. We got to pay attention to this type of stuff because it's important. So we're going to talk about proper protection. Again, glad you guys are sticking around. Hope you're taking some notes. Appreciate the questions. Keep dropping questions in the chat. More than happy to guide you down this path. And again, remember, even one-on-one time, this is what we do individually for people. This is just information we're giving to everyone because we know everyone's dealing with similar things, but we're only going to be able to get through to you if we sit down one-on-one and really dive in, okay? Let's do a quick exercise to pause our brain a little bit. I need you guys to write down the 10 people in your life you love or care about the most. Write them down, think about them, jot them on your phone. Take 30 seconds, just think about them, right? Write them down. 10 people in your life that you love and care about the most. Get a picture of them in your mind. Write them down. These are the people that you care about. These are the people you're doing this for. These are the people that you want to help, that if anything happened to them, you'd be devastated. These are the people that, you know, you trade anything in for, you give anything for, like the people you care about the most. We all got some loved ones and some people we care about. Think of them, all right? Keep them in your mind. Keep them in your mind. As I go through this really quickly with you, I want you to think about this. 4 out of every 10 people will get cancer in their lifetime. So if you just thought about 10 people, I know this kind of sucks, but sometimes you got to understand reality of health and what's happening in this country. 4 out of every 10 people we know are going to get cancer at some point in their life. Okay. 4 out of 10 people also will experience a heart issue, some type of heart attack or stroke. 4 out of 10. So if you just thought of 10 people, 4 out of those 10 will likely get cancer if they haven't already, or will have some type of heart issue at some point in their lifetime. 1 out of 4 people under the age of 25 will experience a disability before they retire that will impact their ability to earn income. 1 out of 4 people under the age of 25, at some point in their life, they're going to have some type of disability that's going to impact their ability to make money. It's going to completely change their financial life forever. 2 out of 5, these are stats that are out there. 2 out of 5 working Americans already report problems with paying medical bills or paying medical debt. 2 out of 5 of those people that are on your list. So 4 out of 10, almost same percentage, right? 4 out of 10 of those people on your list are going to already have problems with paying medical bills or paying off medical debt, or they will. Here's the other side on the life insurance side. Did you know only 50% of Americans have personal life insurance? Only half of Americans have personal life insurance, meaning not through the job, not group term, like actual personal life insurance. And only 30% of them actually have proper life insurance, proper protection. Only 30%. Here's a big one. Less than 2% of all people have a policy with living benefits. Some people don't even know what living benefits are. But less than 2% of the population actually has a policy with living benefits. Well, these are some of the things that we come in and do. Once we know these stats and we think about the people that we love and care about, and we know we have a resource, we know we have the ability to educate, we know we have the right products, services, and people to be able to impact the people in our lives that we love and care about the most. That's how we start to really do do really big things, right? To build big businesses, to get around a crusade, to rally around a crusade, to help our community, to help the people that we know, love, and care about. So we talk about life insurance. We're going to dive into life insurance real quick because a lot of you know this stuff, but we're going to talk about it because of its importance, because we don't really receive an insurance education anywhere. Again, you pick a little bit up from your family,
You know, your grandma, your grandpa told you to get some insurance because they had $10,000 to bury them. And so you want to make sure you got $10,000. But that's really not what insurance is about. And if we don't get an education around it, y'all, then it's likely that, we don't understand this information. So things to know about life insurance. Life insurance only deals with your age and your health. They might look at your driving record or your criminal record because they're trying to figure out how much of a liability are you to hurt yourself or others, right? Or where the insurance company is going to have to pay out. But they're really only looking at your age and health. The younger you are, the healthier you are, the less you're going to pay over time. You may have to do a medical exam, but nowadays in 2025, we don't really have to do a lot of these things because they just pull medical records. You sign a HIPAA release form, they just pull all your records, and they can figure out whether you're healthy or not by whatever you told to the doctor, or whatever medications they prescribe to you, or any of those things. Okay. But just know all policies are not created equally. So you might have life insurance, your cousin might have, but like if you don't know exactly what they have, it's likely that they might not be covered properly. Proper protection is 5 to 10 times your annual income. Okay, proper protection is 5 to 10 times your annual income. Why? Why? Because life insurance, the primary form is for income replacement. Income replacement. This is you and your family, your dual household, a dual income household. You and your spouse, you and your significant other are holding up the household. Both of your incomes are necessary in order for your family to do all the things they want to do. Groceries, the whole nine, right? Bills, all the stuff. God forbid one of your incomes is not in that household. What happens to the rest of the family? What happens to the bills? The bills don't stop, right? The groceries don't stop. The kids still need to eat. Everything still needs to move forward. The only thing that's missing is you, the emotional loss that you're not here, and your income, the money you were going to bring into that household to make sure your kids got to college, to make sure the mortgage got paid and all the stuff. So what does life insurance do? It protects that income. It holds everything back up. It says, hey, you know what? Even though I'm not here, my income will be in this family for the next 5 to 10 years just to make sure that they're still good. Everything I was planning on doing for them will still get done. Fortunately, I'm just not going to be here. I'll be here in spirit. That's what insurance does. It's not for burial. That's how we were educated. That's not the right way to think about it. It's income protection. Income protection. You have, right, insurance. The nature of insurance, it mitigates risk. So what happens if you lose the ability to make money? What if you're disabled? What if you pass away? Like, these are all the things that you should know. Here are all the things that life insurance can be used for. Yes, it is. You can use it for burial and final expense. That is one of the reasons. It's just not the main reason. It can cover education expenses for kids. I think you heard a clip before, right? If you had, you co-signed a student loan with your parent, and you're the 21-year-old, 22-year-old, and you don't have life insurance, like, maybe you should have it, because God forbid anything happened to you, like your parents are stuck with that Parent Plus loan or whatever loan, it doesn't get discharged. So you're going to leave a financial burden on top of an emotional burden. So maybe it just makes sense when you're young and healthy that you pay 20, 30 bucks and get yourself some insurance just in case. Could pay off all those education expenses, pay off debts. Like I said, income replacement is the key. Supplemental tax-free retirement, creating an inheritance and generational wealth. Sometimes we don't think about it this way, but life insurance is the only way to pass down tax-free money. It's the only way to pass down tax-free money. Okay, everything else will get taxed by your estate. So if you want to create an inheritance, whether you have kids or grandkids, or whether you have a church family, or whether you have a great charity, or whether you want to start a charity in your legacy, in your name, whatever the case is, life insurance is one of those things that will be able to do that for you. Creates inheritance, creates generational wealth, pays for estate taxes when you really get to the levels of wealth where people say, hey, I have all of the assets and the trust and all the things. Well, they use life insurance to say, well, this is going to pay for the estate taxes that my family will incur to pass all these things to them. I'm going to pass this whole estate, all these businesses, all this stuff to my kids. There's going to be taxes on this stuff. Well, let the life insurance company pay for the taxes. Let me get a $6 million life insurance policy, pay pennies on the dollar for it for my entire life. Then when I pass away, my family don't have to pay taxes. They just pay with the life insurance money. That's how wealthy people think about it. They taught us it was for burial, right? So we gotta switch the way we think about it. It can create a source of savings, again, provide funds for charitable contributions. It can also create a living benefit and long-term care. We're going to talk about this as we wrap up. But again, gives you peace of mind. That's what life insurance is for. Is if we're building something. Again, think about the premise of why we're doing this, y'all. You're building a financial foundation so that you can build up, so that you can get to all your financial goals. If you have no protection on the underside of your foundation, it's always going to be a potential leak. There's always going to be a potential hole. There's always going to be potential that you can't build a tall enough structure, because as soon as someone gets sick, you can't build it. As soon as someone, right, passes away, you can't build it. Like, if you didn't have this layer in place, your hopes and dreams for what you want to build will get cut short. How many times have we seen this? We have people in our families that they've all had the best intentions. They've all wanted to save and talk to you about saving and doing the right thing. And then they have something unfortunate happen. They get in a car accident. They have a stroke. They get hurt at work. Something happens and their cash flow goes down. Their savings goes away. Their debt piles up. Now they're stuck and they don't know how to get going again because their foundation is all broken. Life insurance, disability insurance, long-term care coverage, living benefits, that holds up your foundation. That's the underside to say, hey, if I happen to get sick, if I happen to get in a car accident, if I'm one of those 4 out of 10 that gets cancer, guess what? We can still keep building this building. My children still deserve all the stuff I was going to get them, right? Like, that's what this is for. That's why we got to be educated on it. There's a bunch of different types of life insurance, but really it breaks down into 2 different things: term and permanent. Term life insurance and permanent life insurance. Those are your 2 types that are out there. Term life insurance is temporary. There's no cash value. You just pay like you pay car insurance. You can get that 5 to 10 times your annual income. If you make $100,000 a year, you get $100,000 of life insurance protection in term. You get a 30-year term policy. You get $1 million of coverage, right? That would be 10 times your income. If you make $100,000, you get $1 million of coverage. If you're healthy, you get a 30-year term. You're 40 years old. You're going to pay like $100 a month for that. It's not a lot. It's super inexpensive. It's temporary, but it'll do exactly what you want it to do in that short window of time. Just know it will expire at some point. There will come a point in time when you're older and more unhealthy, and then you cannot convert it or switch it or anything. It's going to cancel. So it's okay to have it, but you got to know what it's for. A lot of people in our community specifically weren't educated on it and thought that they had life insurance for a long time. And then all of a sudden they were out of their term. It was 20 years. It was 25 years. They were done, and no one educated them about it. So they're like, well, this insurance didn't pay out. Well, maybe they didn't tell you that it expired. When we're undereducated about some areas, ladies and gentlemen, we typically buy things off of price instead of off of value. So if we're not educated on it, we're just going to say, yeah, give me the cheapest one, or give me the thing that fits my budget. Like, yeah, sure. Right. And so that's always going to be term. But if we understand the value of what we're trying to do and create generational wealth and protect our income and pass down tax-free money and right, make sure we have estate taxes all taken care of, then we might want to look at the permanent life insurance side. Permanent life insurance has a few different types of policies, and people get confused about a lot of them. But at the end of the day, they all work very similarly. You have whole life, you have universal life, you have variable universal life, and you have indexed universal life. All of them work a little different, but they all fall under the heading of permanent life insurance. So permanent life insurance is going to last you all the way till you're 100 or 121 years old. So whenever you go, it's going to be there for you, right? Whenever you go, it's going to be there. Each of them have some different benefits to them. The one that we like to talk about, because you just heard us talk about the index strategy, is that IUL, that index universal life. For the right person, that index universal life policy will do wonders for their future financial life. Couple reasons why. One, because you get a good rate of return, anywhere average between 6 and 12%. I wish I had it or pulled it up, right? Our IUL, we get our annual statement. The last annual statement that came in back in October, we've had our policies for a little bit of time. It said it gave us back 9.9% over the past like 11, 12 years, however long we've had them. 9.9%, guaranteed no loss, right? Like in floor, like you can't lose money from a market loss. There's always cost of insurance and those things inside of there. But from a market loss standpoint, it's not like your 401k. So whatever the ups and downs are, we've never had to look at them. They just send us a statement every year. It's like, oh, right, you're up, made 9% over the past years. Okay, great. Better than risking my money. The loan rate, right? If you want to borrow your money outside of there, you pay it back to yourself. Some of them are 0%, so you don't have to worry about, right, being charged anything. And at the end of the day, it's tax-free. It's on the tax advantage side. It's not your 401k, 403b, IRA where you got to pay taxes on it. That cash value inside of those life insurance policies, these permanent policies, the cash value inside is tax-free. So that's how we start to figure out where we have other options to be able to put some of our long-term money. But this is the option for life insurance. You're going to need life insurance and you're going to need to understand how to invest. You're going to need both of them. The question is, do you want to just have some insurance and go off and invest money other places? Or do you want to put your long-term all together in one, give yourself the heading of life insurance, put all of your money in a tax-deferred, safe product that will continue to grow, and that'll be your long-term, and you kill two birds with one stone. Everybody's a little bit different, y'all, but those are the options. It might fit you, it might not fit you. That's when we sit down one-on-one, because again, there's no one financial vehicle that's good for everybody, okay? So that's the insurance part. You got term, you got permanent. Now, two last concepts. You might not have heard of this, but this is why I recommend there's a term policy that we have, that one of the companies we offer is Transamerica. They have one of the best term policies in the market. They have a term with living benefit. The way this works, it says you have your life insurance. Let's say you got $1 million of life insurance coverage, but you also have this added living benefit, and it's like no extra charge. It's like maybe like $1 or $2, right, difference, but like not a ton. So you got your life insurance. So God forbid you passed away, that $1 million would go to your beneficiary, right? But Transamerica adds this thing called living benefit, which says in the event you get cancer, stroke, or heart attack, you have some type of chronic or critical illness in that same time period, in that 25 or 30-year window, that $1 million that was the death benefit will start to pay you and your family while you're alive. It's a living benefit. So we just saw 4 out of 10 people are probably going to have cancer or have some type of heart issue. Well, that's a critical illness, according to Transamerica. So in year 19, you have a term policy that you're paying $100 a month on. In year 17, right, you're 40 years old, year 17, you're 57 years old. God forbid you have a heart attack. You start to accelerate that $1 million to pay for your life. They'll give you up to 90% of that value. That's $900,000 because you were paying $100 a month for a term policy that came in handy when you needed it. I told you less than 2% of people have a policy like this. But how would this benefit you if you already know something like that could potentially happen? 4 out of every 10 are going to have something like that happen. Wouldn't it make sense for them to have something like this in place? Wouldn't it make sense for you to tell like your cousin or your uncle or your nephew or your son or your like, hey, you probably want to at least, I know you might not care about life insurance, but you probably want to think about this living benefit side of things that I just heard about. If you get cancer, stroke, heart attack, you got some chronic or critical illness, it's going to start to pay you just to take care of yourself so there's no burden on the family. So we don't have to pull out of our retirement accounts. So we don't have to liquidate our savings because, right, so-and-so had an illness, fell on hard times. That's what happens to most families. This is a policy that saves you from that, and it has life insurance coupled with it. So God forbid you passed away, all the rest of that money goes to your family anyway, tax-free. People need to hear that. You might need a policy like that. That might be something for you. That's the living benefit side. The other side is called long-term care. Long-term care, ladies and gentlemen, is if you need hospice care, in-home nurse, nursing facility, something like that down the line. You can't do 2 of the 6 daily activities of living. You can't bathe yourself. You can't feed yourself. You have dementia. Like you need assistance. These are some of the numbers. I don't know if y'all know this stuff, right? Me and my wife went through a little bit of this taking care of my grandmother. But like, it's expensive. It's expensive, y'all. The average, right, annual cost for assisted living facility is $64,000. Like, if your parent is just on Social Security and doesn't really have retirement, where are you coming up with an extra 64 grand a year to take care of them? Home health, if you want someone to come in, average, it says assumes 44 hours a week, 76 grand a year. It's like you have to have a whole second career in order to take care of one bill for your ailing loved one, for your mother, for your father, for your grandmother, grandfather, whatever it is. Not to talk about nursing homes and private nursing homes. Like, we're getting into the six figures a year for care, just for care, right? You guys heard this, but I'll play it again for you. This Damon John quote, right? Damon John, right? Shark Tank, creative FUBU, was having this conversation. Listen to what he said about long-term care.
What about long-term care? We're going to take care of our parents 2 times longer than they took care of us. If you are right now 30 or 50, under 50 years old, you could probably get a long-term care policy at probably maybe $50 a month. Because by the time you're 60, 70 years old, God forbid you have dementia and all these other things that are growing and you have to get long-term care, it costs an average of, for you or your parent, it costs an average of $20,000 a month to get a decent amount of long-term care. So imagine if you had $3 million in the bank and both your parents have to go to long-term care for 3 years. Your money's gone. This is all about having financial intelligence. And those long-term care policies could be annuities.
That's Damon John giving you a little information on how important this type of stuff is, that, again, we don't really talk about it a ton, but these are the holes in our financial foundation. I know we want to go off and do all of the sexy things that we think are going to make us a bunch of money. I get it. But and again, this is just wisdom from us being here for over a decade. It's important to understand how to go get it. It's important to understand where to invest. It's important to understand how to go build it. It's also important to understand why people don't. It's both sides. You got to understand how to go do it, but you also got to understand, like, what has stopped people from doing it. Have you ever thought about that? If you don't come from wealth, if like your family doesn't come from this, have you ever asked like your family, like, how come y'all didn't do this? How come y'all didn't build wealth? Like, how come everyone knows money is simple, right? Spend less than you make, save and invest for the long haul, stay out of consumer debt. Like, how come you didn't do it, mom? How come you didn't do it, dad? Hey, grandma, grandpa, how come y'all didn't do it? And it's probably going to come to some form of, well, we had these things come up. We had to take care of our children. So and so got diagnosed with diabetes. So and so got sick. We had to take care of this person. This house got foreclosed on. This person lost their job. This person lost their business. Like, it's all the same things. So if you want to be different, ladies and gentlemen, you got to know both sides. You got to know how to grow it, but you got to know why people don't. It's not because they're less they didn't have the same resources, but like, they had the same intention that you had. They have the same intentions that you have to go off and design your ideal life financially. The people that came before you had the exact same intentions, I'm pretty sure. So you got to know both sides. Things like this, like long-term care, like a living benefit policy, like life insurance, like just understanding the protection side of your investment life is crucial. It's crucial. These are some numbers on the screen. Again, talks about the median monthly cost of a private room, right, in the nursing facility side. The highest one on here says $27,000, almost 28. That's in Alaska. God bless people that live in Alaska. But again, if you live in Alaska, the median, that means the middle, half or less, half or more, cost of a private nursing care is $27,000. You can find your state on there. Texas, 6,500, California, almost 10,000, right? Pennsylvania's 10,000, right? Like, this is money that will come out of your investment life. That's what Damon John just said. You did all the right things. You got $3 million invested in crypto and stocks and all the stuff. And then your parents need long-term care. There it goes. What are you going to do? All right? You got to pay for it. So you got to liquidate your investments. Or you could go talk to one of us and talk about getting a long-term care policy now. Pay a few $100s a month. Pay $100 a month. Get some protection. So if the inevitable happens, there's a policy there that already takes care of you, and you don't have to worry about dipping into your savings, ladies and gentlemen. This is incredibly important. This is where we're going to end up tonight, just so you know. Scan that QR code if you have questions specifically about insurance. specifically about what we talked about, life insurance, whether you want to know the difference between term and permanent and which one's best for you, whether you want us to take a look at your insurance policy. Again, whether it's us or whether it's someone that invited you here, we have an insurance license and we can help you with those things. Maybe you do want to look at a living benefit policy, or what does a long-term care policy look like? And I know there's a bunch of people that are probably going to reach out and say, hey, my 79-year-old mother needs life insurance. God bless her, right? She probably won't get long-term care or living benefit at that stage. This is the problem with life insurance. There is a point where it's too late, like where you've waited too long and now you can't take advantage of these products. You already have a pre-existing condition. You already need some form of hospice. They're already at that place. They won't get approved for long-term care. They won't get approved for a living benefit. The insurance company knows they're going to have to pay out more than you pay in. That's not a smart bet for the insurance company. But you're 37, you're 42, you're 49 years old, you're 51 years old, and this is resonating. Like, you are the person to get your insurance, get your long-term care, get your living benefit, get all that stuff in place now. So we're not waiting until we're 75, 80, 81 and trying to figure out what options do we have. The financial industry, the insurance industry, I'll be honest, is not very accommodating to older people. It's not what it's meant for. It's meant for younger, healthy people. You are the people that take advantage of these products. As you get older, there will come a point in time where it's like, it doesn't make sense. We've had a few different clients where you sit down with them, they're at that age, it's like, it doesn't make sense for you to go get this insurance policy. It doesn't make sense. You're going to pay too much and the benefit's not great enough. You need to just start saving some money in the bank right now and set it aside. That's an option. But again, we're trying to save the people that need it, that know, like, man, this could be something. We want to have a conversation with you. Feel free to scan that QR code. Also, invite the person that invited you, reach out to them. They have more information. Again, we're a huge network of people. We're a huge team, right? So if they invited you, talk to them. They'll point you in the right direction. They'll set up time with us. They'll even be able to do it for themselves with you to make sure that your family's properly protected, okay? But let us know how we can help. If you have questions, any questions, feel free to drop them in the chat right now as we wrap up. Any questions, comments, concerns? I told you I was going to talk fast and give you a bunch of stuff tonight. If you were taking notes, I'm sure you probably have a bunch of notes. If you have further questions, feel free to reach out either, again, to the person that invited you here or reach out to myself or my wife. We're more than happy to answer the question. I don't know if we've explained this before, but what we do is complimentary. Just like we're giving you all this information, complimentary. You didn't have to pay to get on this training. You didn't have to pay to get on this boot camp. When you meet with us one-on-one, you don't have to pay us either. We'll take time with you. We'll educate you. We believe that this information should not be gatekept. It should not be according to how much money you make or don't make or have or any of those things. You and your family deserve this financial information to go off and change your financial life. If we can help you here at United, we're going to be able to help you get to that place. All right. So feel free to drop questions or come back around and ask some questions. Hey, if you want some resources, we're always big on giving resources. These are, books that are out there that may touch on some of the stuff I talked about with you. So Money Master the Game by Tony Robbins, great book. It's like 600 pages, but it's a great resource for you to think about and talk about kind of how to start building your financial foundation. Retirement Miracle by Patrick Kelly talks a little bit more about that 401k stuff, that retirement stuff that we talked about. And then again, 401 Chaos by Andy Tanner. He's connected with Robert Kiyosaki. He wrote Rich Dad Poor Dad, right? Again, talking about some of the same things that we just talked about tonight. Again, I'm just the person giving you the information. Once you have it, you got to make some decisions. You got to make some decisions. If you don't want to make them by yourself, come talk to us. We're more than happy to guide you down the right path. We also have a free ebook. We have a life insurance ebook and a savings ebook. If you were on yesterday, you could have gotten our debt ebook as well, or our cash flow ebook. Those are all free resources for you. Those are the links. You can feel free to download those as well. Get those. Again, they're easy reads. Send them to somebody. It's going to basically go over a lot of the stuff that we've already talked about today, but we know sometimes you need some things in your hand, even though I've already told you should be taking some notes. But regardless, you can feel free to get those ebooks at your convenience and they're definitely going to be able to help. Go over to our YouTube if you wanted some more conversation from anything today. Our YouTube channel, there's a playlist on there that says Life Insurance 101. It's got like 10 to 15 videos in there that I've done over time, that we've done over time, that give you some basic information and basic education similar to what I talked about tonight around life insurance. Okay, again, go to our YouTube. It's the United Agency YouTube channel, and there is a playlist on there that says Life Insurance 101. There's a bunch of other videos on there if you want to browse, but this specific playlist is for life insurance, so feel free to go over there and take a look at that. And join us tomorrow, ladies and gentlemen, on night 3. It's the final night of the boot camp. We're diving into estate planning, wills, trust, being able to optimize our taxes, all of those things. We have a special guest, Atia Brown, coming on tomorrow. She's a savvy accountant. She's a CPA. She's the person that's going to be able to, we're going to, just like we did yesterday, do a little Q&A. So if you got tax questions, right, how you're being taxed, or how the money comes in, or investment tax, or capital gains, or any of the stuff, we got a CPA coming on tomorrow that's going to be able to answer those questions. So again, share this with a friend or family, whether it's here on Facebook, whether you give them the link and get them here in Zoom. But we want people, again, to get this information. My wife just dropped the eBooks in the chat there, so you can feel free to get those eBooks. I don't know if that's the right link to the eBooks actually, but either way, if it's on there, we'll do it. Again, join us tomorrow night. 8 p.m. Eastern, 7 p.m. Central, 5 p.m. Pacific for the final night of our Financial Foundations Bootcamp. Hopefully these have helped you and they have added value to your life. Right, and again, if they have, feel free to send this to a friend or a family member. But until tomorrow night, y'all, we're gonna sign off. Have a good night. Talk soon. All right, guys, we just finished up the second annual United Agency retreat. I know, listen, why did you start laughing? Anyway, we just finished up the second annual United Agency retreat with all these champions you see behind us. It was an amazing time. We got a chance to bond. We got a chance to have dinner. We got a chance to eat and fellowship together. Most importantly, we got a chance to inspire, motivate, and build one another together. Community and relationship is the key to building anything. And with these champions right here behind us, we're gonna go off and build something amazing. We're looking for people, looking for us. And at the end of the day, we want to be able to inspire those that are out there to want a better life, to want to be able to grow, to want to be able to get financially free and financially independent for them and their families. We took time this week to be able to do it for these champions and their families. Now we're going to come do it for your family too. Let us know how we can help. But we're here, United Agency. Remember the shirt, United. That's who we are. We're coming to make things happen. What do you got to say, babe?
I think you wrapped that up really well, baby. It was a phenomenal retreat. It gets better every single year. And that's what we're doing. We're trying to build community, fellowship, and longevity. That's really the important part of building business is longevity. So that's what we're excited to build relationships that last forever.
That's it. And so until next year, we'll see you guys next year. Take care. Woo! All right, guys, we just finished.